The president's SONA touched on agriculture, infrastructure, and social supports, but left the business community with more questions than answers. There was little on trade strategy, industrial policy, or a clear roadmap for growth. And with global tariffs, weaker exports, and easing interest rates, business leaders are looking for direction. They need signals they can act on and policies they can plan around. Joining us now to connect the dots is Security Bank's chief economist, Angelo, and he's also a former assistant secretary at the Department of Trade and Industry. He's going to help us make sense of these signals and the risks facing Philippine businesses. Hi, Angelo. Thanks for being here with us.
Thank you for having me, Mikey.
Angelo, as an economist and as a former DTI official, what stood out to you the most in the president's SONA? There was what was said and there was what wasn't said. What stood out the most?
Well, I think the theme of the SONA is geared towards social services, touching on the essentials that are basically important for Filipino households, such as food, water and electricity, transport, healthcare, and also infrastructure, among others. So, of course, the market is expecting, prior to the SONA, some discussion on recent developments pertaining to trade and also on a sector-specific issue, such as in online gambling. But understandably, these two have been still ongoing on the tariffs still being negotiated by our government officials, and also on the online gaming side still being studied with the aim to generate taxes and also to regulate this industry.
Analysts were saying it was a politically safe SONA. That said, there's that 19% tariff, that 1% tariff cut, but we're still left with that 19% tariff, and it could squeeze Filipino exporters, dampen investor sentiment. The Philippines stands to lose 3 to 6 billion pesos a year under this zero tariff deal with the United States. As an economist, what are your thoughts on this and how might it affect us?
Well, the 19% tariff is comparable to our ASEAN peers. So we had 19% also for Indonesia and 20% for Vietnam, and still in the works for Thailand and the rest of ASEAN. So it's sort of uniform within the region. And in comparison, the Philippine economy is more domestic-oriented, since above 70% of our GDP comes from household consumption. And even if we combine exports and imports, their share would not be enough to offset household consumption. So we are relatively less adversely impacted by the tariff as opposed to the other peers in the region.
You mentioned uniform, but not exactly so uniform. While the tariff rates are relatively the same, the competitive landscape between Vietnam, the Philippines, Malaysia, Indonesia, between our ASEAN neighbors, it's not exactly the same. So going to GDP growth, I understand that you revised your economic targets last week ahead of the SONA in light of the tariffs from 5.9% GDP growth to 5.6% for the full year 2025. Doesn't seem like that much of a difference between 5.9 and 5.6. Can you tell us about what went on to merit the decrease?
As we learned about the 19% tariff, which is higher than the baseline of 10%, we decided to trim our GDP growth outlook for the second half of the year by only 20 basis points. And given that, with also our estimate for second quarter GDP pegged at 5.6%, we now have our full year growth forecast slightly lower from our previous estimate at 5.6%. So basically, this is largely driven by the higher tariffs that will be enforced second half of the year, and also certain headwinds still coming from the trade policy uncertainty that's worldwide, as well as the geopolitical risk. As now, we have been seeing also a recent pickup in global oil prices again, I think it's up by 6% for 2 straight days already.
Yeah. On the one hand, inflation has been benign. Your targets for inflation unchanged at 1.9%. We get inflation data for July next week. Your expectations are for 1.2% despite the typhoons. Can you tell us about how you came around this figure?
The year-on-year 1.2% estimate is because of the high base effect coming from the same period last year. But on a month-on-month sequential basis, it has accelerated based on our estimate by 50 basis points coming from June. So it's still lower from previous months on a year-on-year basis, but potentially higher on a month-on-month basis.
Yeah, but still, your forecast of 1.2%, your house view of 1.2%, that gives the BSP so much more room to cut interest rates. BSP Governor Eli Remolona hinted at a rate cut. He said that was on the table this August, perhaps even another one in the fourth quarter. Is this in line with your own house view on monetary policy?
Indeed, we are still expecting another rate cut. But the timing of it, we think, even though Governor Remolona mentioned it's on the table in August, for us, we think that there is a need for the Fed to cut first before the local central bank can proceed with a third for the year in order to preserve the interest rates differential, which currently stands at 75 basis points. Or a historic low.
Yeah, razor thin interest rate differential. In this kind of macro environment, Jello, as an economist, what are you advising businesses to do? What is it? Is it the time to wait and see? Is it the time to expand? What are your thoughts given the current landscape?
Well, since the SONA has outlined several thrusts of the government for the next 12 months, in terms of improving the budget utilization and also still prioritizing key areas such as infrastructure, I think the local business community can take response from that by continuing with its plans in order to take advantage of the still resilient domestic economy.
Yeah.
And therefore, because inflation is still benign, and that is our outlook for the remainder of the year, with policy rate cuts still ongoing, then borrowing costs will still go down. Market rates are likely to be driven lower, and there is also potentially more upside on capital markets such as the local stock market because of the lower discount rates, and hence the domestic-oriented nature of the Philippine economy will likely become more vibrant as opposed to the external global economic environment given the headwinds coming from the higher tariffs. So no wonder even the growth outlook for next year is more upbeat. As in our case, we are still also looking at a faster growth for next year compared to this year, in light of the aforementioned factors, benign inflation, lower rates, and also domestic resiliency.
So in a nutshell, Jello, when you talk to your clients, as you do as an economist, what are you telling them?
Well, for those who are investing, of course, the advice is still stay invested, and at the same time, take a closer look at potential opportunities. For example, since we just had the recent reduction on the stock transaction tax from 60 bips to 10 bips, thanks to the CIMEPA, then that could be an opportunity for the stock market to improve. We have seen since the start of the month of July, a higher trading volume activity, and therefore foreign investors are taking a closer look at the local bourse. And once foreign flows come in on a more sustainable basis, then that will provide more upside to
That's what we're really waiting for.
Local market. Yes.
Jello, with the rate cuts on the table, what's your outlook for the peso? Because that's going to have a significant impact on how foreigners view the Philippines.
We are still seeing the dollar-peso exchange rate to settle at 57 by the end of the year, which is not much different.
57 flat.
Yes, from the current level, because there are offsetting factors to the widening trade deficit of the Philippines, and that mainly comes from the US dollar's inherent weakness, as investors are still not too upbeat on the dollar, given that higher tariffs. So that is offsetting the potential depreciation on the peso given the widening trade deficit.
So if you were to describe the state of the Philippine economy in this second half of the year, how would you describe it?
Well, it's still a business as usual, domestic economic performance, and given the macro backdrop already improving, then we could see a quickening of this domestic economic recovery moving forward over not just the next year, but also potentially in the medium term.
Okay, that's what we're looking forward to, a quickening recovery in the domestic market. Thank you for your time, Angelo, Chief Economist of Security Bank.
Thank you.